$214.5 billion sell-off risk. Is Tesla's growth destroying value? Tesla's $214.5 billion sell-off risk demands a stronger capital strategy to protect future business growth. Tesla just erased $214.5 billion in market value after a 14.5% share price crash, proving that if you ignore capital discipline, your growth story can quickly become a valuation crisis. You should notice that Tesla still generated around $28.2 billion in quarterly revenue with approximately 26% year-over-year growth. Yet investors focused far more on weakening profitability than expanding sales. The biggest warning for you is that earnings per share dropped to just 33 cents, while operating income declined roughly 57%, making investors question whether future returns can justify today's spending. Tesla's automotive margins fell to approximately 16.9%, showing you that even strong revenue growth cannot protect shareholder confidence when operating efficiency continues moving in the wrong direction. You should pay close attention because quarterly capital expenditure climbed to approximately $5.8 billion, pushing Tesla into its first period of negative free cash flow in more than 2 years. Tesla now expects 2026 capital expenditure to exceed $25 billion, making this its largest investment cycle ever and forcing investors to ask whether aggressive expansion will generate acceptable financial returns. Your biggest takeaway should be that markets no longer reward ambitious investment plans unless leadership clearly explains when those investments will actually begin producing measurable cash flow. Tesla is simultaneously investing in robotaxis, Optimus humanoid robots, AI infrastructure, semiconductor development, manufacturing expansion, batteries, software, and energy storage, creating enormous execution complexity for investors to evaluate. Even though Tesla reportedly holds more than $43 billion in liquidity, investors remain concerned because future financing requirements could reportedly reach nearly $30 billion if spending continues accelerating. You should understand that today's financial markets reward free cash flow, return on invested capital, capital efficiency, and earnings visibility far more aggressively than exciting long-term innovation stories. Higher global interest rates have completely changed the investment landscape, meaning you cannot rely on cheap financing anymore because every dollar invested now faces much stricter return expectations. Boards, executives, and investors should recognize that large investment programs require measurable milestones because financial markets increasingly punish uncertainty instead of simply rewarding ambitious corporate vision. L-Impact Solutions believes Tesla's $214.5 billion one-day market value destruction was far more than an earnings reaction because investors questioned whether management maintained sufficient capital allocation discipline. Despite reporting approximately $28.2 billion in revenue, Tesla disappointed investors with automotive margins near 16.9%, adjusted EPS around 33 cents, and more than $1 billion in negative free cash flow. You should remember that every additional $1 billion invested into AI, robotics, manufacturing, or semiconductor projects also increases execution risk, commercialization delays, and future financial uncertainty. Tesla plans to spend over $25 billion during 2026, compared with roughly $8.5 billion during 2025, nearly tripling annual investment commitments within just 1 year. You should ask whether multiple capital-intensive businesses can realistically mature together without placing excessive pressure on operating cash flow, profitability, and shareholder confidence over the coming years. Global AI spending competition keeps intensifying because Alphabet plans approximately $195 to $205 billion in capital expenditure, while Microsoft, Amazon, Meta, Oracle, and others continue investing tens of billions. Investors increasingly compare companies using ROIC, free cash flow yield, EBITDA conversion, operating leverage, and capital productivity, rather than simply believing ambitious technology narratives without measurable financial evidence. You should never underestimate investor communication because vague promises about future innovation often create more uncertainty than confidence when billions of dollars are being committed. L-Impact Solutions believes management should clearly disclose investment payback periods, hurdle rates, IRR expectations, commercialization schedules, and operating margin recovery targets before requesting additional shareholder patience. Financial markets increasingly value credibility over ambition because predictable earnings and transparent execution now influence corporate valuation more than aggressive expansion announcements alone. You should prioritize measurable financial metrics including ROIC, NPV, IRR, DCF analysis, commercialization probability, execution complexity, regulatory exposure, and projected cash conversion before approving major investments. Instead of approving unlimited spending, you should release only 10 to 20% of project capital initially, followed by 40 to 60% after engineering validation before funding the remaining investment. You should ensure commercial demand, operating margin improvement, and cash flow performance meet predetermined milestones before authorizing the final stage of capital deployment. Companies should maintain enough liquidity to comfortably finance 18 to 24 months of planned capital expenditure while preserving positive operating cash flow whenever reasonably achievable. You should diversify financing through internal cash generation, long-term debt, equity funding, and strategic partnerships while maintaining contingency reserves covering potential project overruns of 10 to 20%. Quarterly reporting should include project-level investment, commercialization dates, annual revenue forecasts, target operating margins, expected ROIC, cumulative free cash flow, production utilization, and engineering completion percentages. You should reduce concentration risk by balancing mature cash-generating businesses with emerging growth initiatives instead of depending entirely on one transformational technology platform. Enterprise leadership should regularly model downside scenarios including 10%, 20%, and 30% revenue declines together with borrowing cost increases of 100 to 300 basis points. You should also prepare for commercialization delays lasting 12 to 36 months, alongside supply chain disruptions, commodity inflation, labor shortages, geopolitical uncertainty, and evolving regulatory requirements before expanding investments. Executive compensation should reward free cash flow growth, ROIC improvement, operating margin expansion, capital efficiency, earnings quality, and shareholder value instead of simply rewarding higher spending. L-Impact Solutions recommends establishing independent capital investment review committees to evaluate every strategic investment exceeding $500 million, $1 billion, or 2 to 5% of annual operating cash flow. You should connect capital expenditure directly to measurable financial capacity instead of strategic optimism by maintaining minimum liquidity, acceptable leverage, and disciplined interest coverage thresholds. Management should continuously monitor engineering productivity, manufacturing throughput, project completion rates, asset turnover, working capital efficiency, EBITDA margins, and cumulative project cash burn before investors react negatively. Annual stress testing should measure how 15 to 30% lower sales, 6 to 24 months of product delays, higher interest rates, and geopolitical disruptions could impact future liquidity and profitability. You should publish commercialization milestones, cumulative capital invested, expected annual revenue generation, operating margin progression, target free cash flow recovery, and project-specific ROIC every quarter to strengthen investor confidence. Companies building evidence-based investment decisions, disciplined governance, independent reviews, measurable accountability, and continuous benchmarking consistently achieve stronger long-term capital efficiency than purely vision-driven organizations. You should remember that higher interest rates, tighter credit markets, government debt, inflation, and fierce AI competition make disciplined capital productivity essential for sustaining future corporate valuations. Tesla's experience proves that approximately 26% revenue growth alone cannot offset investor concerns when EPS falls to 33 cents, margins weaken, and free cash flow turns negative. L-Impact Solutions emphasizes that the real challenge is balancing innovation with disciplined governance, so ambitious expansion never compromises financial resilience or long-term shareholder value. You should phase every major investment through measurable commercial milestones because disciplined execution consistently creates stronger enterprise resilience than uncontrolled capital expansion during uncertain economic conditions. Rising institutional expectations mean you must demonstrate sustainable earnings, predictable free cash flow, higher capital productivity, and transparent governance before markets reward ambitious AI investment strategies. Your long-term competitive advantage will depend less on how much capital you deploy and more on how efficiently every investment dollar produces durable earnings and measurable shareholder returns. The broader business lesson is clear. Hundreds of billions will continue flowing into AI, automation, robotics, and advanced manufacturing, but disciplined governance will increasingly separate winners from capital destroyers. Before your organization launches its next multi-billion-dollar investment cycle, ask whether every dollar truly strengthens resilience, improves predictable returns, and creates sustainable long-term shareholder value instead of unnecessary financial risk. Can your AI growth survive without reliable nuclear power? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.